webcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Ashwin Gupta this side from Hdfc Securities. A warm welcome to attend this webinar on a topic called Emargin, that is margin trading funding. In this topic, we will talk about our product called Emargin. At the same time, we'll also talk about how this product functions and how to place an orders with respect to the product called Emargin and how will it benefit you as an investor. So our topics for the day would be key features of Emargin, that is 275 days. We'll also talk about the concept of Emargin versus cash. I will take an example of cash versus Emargin. Also explain you the details of Emargin with regards to the research report. We'll talk about that as well. How to check the upfront margin. Every script has a different margin, so we will also check how to check the upfront margin which is applicable, how to do the consolidated report and understand the consolidated report. MTF pledge. We'll also talk about the MTF pledge, which is an important topic. How is the margin calculated? How to place orders from ITS platform or a Pro Terminal mobile app platform. So let us continue with the same. When we talk about Emargin, the name itself says margin, which means buy today and pay on or before 275 days, which works out to be approximately 4 quarters. That is approximately 1 year. So your customers can pay a small portion of fraction amount of money and enhance the buying power. That buying power, once enhanced, customers can pay the remaining amount up to period of 12 months. That is 275 trading days. When I talk about trading days, it is from Monday to Friday. Saturday, Sunday is not a trading day, and also as well some holidays. So your customers can take the positions up to 275 trading days. That comes to approximately a year. So wherein customers will hold these positions, which also gives the power to the investors to hold and to hold the stocks and buy more with limited funds or small portion of stocks. Usually customers will pay 30%, 35%, 40% margins depending on the script. When I talk about higher margins, it also implies that customer would get higher profits, or profits potential will also be higher if in case the price of the stock goes up. High leverage means an opportunity to get a higher profit potential. This also helps the investor to earn more with limited resources. When I talk about margin, or when I talk about buying power, which means I as HDFC or we as an HDFC, we will fund customers account with the remaining amount, and that will be charged interest, that is 0.05 per day on an outstanding amount. So here customer will pay around 0.05 outstanding 0.05 interest on an outstanding amount for the amount which customers has used from HDFC Securities. Interest is only charged from settlement to settlement, means from the period of first settlement till the period of next settlement, we will not be charging interest for the entire year. If customers use the funds for 20 days, I will charge interest for 20 days. So customer, depending on the users of funds, I will be charging interest on the utilized amount for the utilized period, specific period. Customers can also pay cash and take emerging positions, or customers can keep shares as collateral. So it depends on customer to customer. Some customers may say, okay, fine, I have 30% cash, I will pay 30% cash. Some customers may say, okay, fine, I do not have cash, I have some stocks. So against those stocks, we'll give some limit that will be known as shares as collateral. And against those shares as collateral, against those limit, customers can take positions in Emargin. Stocks in which Emargin's positions are taken needs to be kept in client's Demat account marked as pledge. So here, customers' stocks will be marked as pledge, and they will be kept in Demat account of the investor itself. So I will let you know when the position needs to be marked as pledge, and the customers can continue these positions till 275 trading days. If not, the positions are squared off. We'll let you know about the same. When I talk about MTF product, the product is available across all the platforms. Customers can place an orders through Empowered website, mobile app, or Pro Terminal. So these are three different platforms, and it's absolutely fungible, wherein customers can trade in any of the platforms. So customers can place in orders, and through Empowered, they're absolutely fungible and flexible. Customers can place the order from any of the platforms and modify or cancel the orders as well. When I talk about Emargin, the positions can be taken for approximately 640 shares, approximately substantial market portions of the main frontline stocks. The positions can be taken. So around mid cap, small caps, we have diversified our MTF stock list in mid cap, small cap, and large cap. Even on MTF, even on ETF, sorry. So customers have choice. They can buy, they can take positions in uh, uh, any of the scripts as they wishes to do so. But at the same time, do remember, it's very important. Customer needs to diversify the funds in different sectors or different stocks as well. In case customer has taken the Emargin position today and squared off on the same day, no interest is being charged. No interest is being charged if a customer takes the position today and squares of the position today itself. It will be considered as intraday, and no interest would be charged on that specific script or a specific day. Here we'll explain you the cash versus the Emargin. How is both the product different? When we talk about cash, most of investors buy stocks and keep it for long term. They feel okay, fine, when the price of the stock goes to 10% or 10 15% or 20%, maybe in a period of 6 months or 1 year, 8 months, 9 months, we'll square it off. Customers who are willing to buy stocks and sell it off when the market goes up in a short term duration, then customers are looking for a bullish view in a specific stock. Then MTF has a better advantage to buy a stock as compared to cash margin or as compared to cash market. So we'll explain you with the help of an example. For example, a stock called ABC has a bullish view. Current market price is 100 rupees. Expected market price is 125. Current market price is 100 rupees. Expected market price is 125. Assuming a customer would like to invest 1 lakh rupees, assuming customer would like to invest in would be interested in investing 1 lakh rupees, he would be investing 1 lakh divided by 100, that is 1000 shares. So 1000 shares of ABC, 1 lakh shares of ABC, 1 lakh amount of ABC at a price of 100 would come to 1000 quantity. So customers would have bought 1000 quantity of 100 rupees each, that is 1 lakh. In case the target reaches 125, in case the target reaches 125, 1000 into 125 becomes 1,25,000. Here the profit comes to 25,000, that is the gross profit. Hence profit comes around 25,000 minus the brokerage minus the government taxes. So it would be a nominal profit. I would say invested 1 lakh, earned 1,25,000, that is 25,000 minus the charges, that would be the net profit for the customer. However, in Emargin, whenever positions are taken in Emargin, here gives a leverage to the investor and he buys 3 times more than the earlier position, because depending on that stock, generally 30%, for example, if it is the margin percentage, if 1 lakh is invested, assuming 1 lakh being 30%, he would be able to buy 3 lakh worth more than 3 lakh shares, 3 lakh amount of shares. So 3,000 shares of 3 lakh rupees amounting 100 rupees, 3,000 quantity. Now, assuming the target reaches 125, assuming the target reaches 125, 3,000 into 125 comes to 3,75,000. Here, the profit has amplified and profit has increased from 25,000 to 75,000. But here, customer would be paying the interest cost as well. Customer would be paying interest cost as well. That is 0.05 per day. That is a very nominal charges, wherein customer will be paying interest on the leverage amount. The customer would be paying leverage at interest on the leverage amount. Now here customer has an option, either he can close the position or he can convert the position anytime during the contract period, because he's not obliged to square up the position or he's not obliged to convert on delivery. It all depends on the investor, whether the investor wants to square the position and take the profit. The entire profit will be credited to the client's customer's account, minus the brokerage, minus the interest, as I said earlier. When we talk about Emargin, it is very important for our customers to know how much is the success rate, how many calls have we issued, how much how much returns have they gained, and what is the average holding period for customers. For our average holding period for research, we do give research calls. Now in this financial year we are given around 215 research calls, out of which 131 were positive. 63% success ratio. Average return is 2.7 for 9 days, which means an year, for a month it would be approximately 3%, and approximately for an year it would be around 108%. So for a month it would around 9%, and for a year it would around 108%. So our success ratio calls or success ratios are 63%, and average return is around 9% per month. 9% per month. So your customer would be paying interest of 0.1 for per 1 month. He would paying 1.5, and returns he would get around 9%. I would also add the brokerage, I would also add everything. It would be approximately 1.5 plus the brokerage. Maximum customer would be charged interest or the brokerage. Everything would be around 3%. Net income customer would get around 7% if a customer holds the securities for a period of 1 month. This is just an assumption. These are the past returns which we are talking about. So we also know about the script as well. Now, when we talk about Emargin, the most important thing customer would like to know, how much margins am I paying in each and every script. So here you can see the example in front of us on the slide. Script called Goodyear. Customers bought at different dates at 24th Feb, 16th Feb, and 22nd Feb. The paying dates would be different because that is the T plus 275 days. The gross buying price would be different at different dates, and the margin applicable is 30%. Sorry, 35%. So 35% of the margin applicable on a closing prices. What happens here if the price has the stock has bought 100 rupees? If the price of stock goes to 110, we will charge 33 margin. If the price of stock goes to 90, we will charge 27 margins, 27 rupees margin. So here, if the price of the stock goes up, the margin increases. If the price of the stock goes down, the margin also decreases. So depending on the price of the stock, the margin increases or decreases. It is always base. So here customers would come to know how much margins am I paying on each and every script. So this report is sent to the customers on daily basis in the morning, wherein customers can check the details of the margin which is being charged to the customer on open positions. Below the table that is called a summary of e-margins part B, it shows the total applicable margin which is being charged to the customer. Now customer has given shares as collateral or cash as collateral. Depending on that, the margins are depending on that the margins are being charged, debited or credited to the customer's ledger account. In this situation, in this example shown on screen, here customer is given share as collateral. Hence, I'm also showing the table securities utilized or collateral utilized against e-margins. So here it shows how much, which share has he given, how much quantity, how much the amount, and the haircut. This is the total collateral valuation, and the customer has used the half of this. So here, if the customer is paying the cash as margin, cash as collateral, then this the last column wouldn't show, as this report shows only for those customers who have taken positions against the stocks. Now, when we talk about this, it is very important for us to know what is the margin pledge and how it is functioning. For example, if a customer bought the shares on Monday, if the customer buys the shares on Monday, T plus 1, that is on Tuesday, the shares will be getting credited in Tmat account. When a customer bought on shares on Monday, T day customer takes an e-margin positions. T day customer takes a position e-margin positions. The day on which the trade happens, that is called the T day. T plus 1 day, the next day, the payout of shares will happen from exchanges. The next day, the shares will come to our demat account on by exchanges on T plus 1. And the shares are sent to the customer's demat account marked as hold. Now on T plus 2 day, links are sent to the customers. Links are sent to the customers for accepting the pledge. So NSDL will send a link directly to the customer's email ID stating these shares needs to be pledged. Once these links are sent to the customers, those links are valid till T plus 2. That is, if I've talked about taking the position Monday, this link will be sent to the customer on Wednesday, and these links are valid only till Wednesday evening 9 p.m. The links are valid only till Wednesday evening 9 p.m. Thereafter, the links will expire. Customer would not be able to accept the link. If the pledge is not accepted on T plus 4 day, customers' positions will be squared off. Customers' positions will be squared off. This is as per the guidelines. In case customer says, okay, fine, I want to convert those shares into delivery, customers can pay the remaining 70% amount and convert the shares into delivery. In case customer says, no, okay, fine, I want to square the position will be squared off on T plus 3, and the positions will be squared off by a risk team. So customer has a choice, either they can square the position or they can convert into delivery by paying or by bringing in more funds, the difference amount. But it is very important, customers need to understand pledge is very important. So we'll talk about how is margin calculated. For example, stock price rupees 100, 30% margin is 30 rupees. So I charge the customer rupees 30. Now there can be two possibilities, either the stock price may go up or the stock price going down. The first instance, the stock price goes from 100 to 90. Once the price of stock goes from 100 to 90, the new margin applicable is 27 rupees, from 30 to 27 rupees. Now, if the customer has given 30 rupees margin initially, now we are charging 27 margin, 3 rupees will be credited or refunded to the margin account of the customer, where these funds will be kept in the client's bank, client's trading account. In case the next day, for example, the next day price of shares move from 90 to 95, then customers new margin position will 28.5, and we'll have to refund the amount which we have debited from customers trading account. However, in both the cases, margins will be charged in case the price of the stock goes up. MTM will be charged, MTM loss will be charged in case the price of the stock goes down. So in both the cases, MTM will be charged if it is a loss. If it is a profit, will not credit any profit as per SEBI guidelines. If in case extra margin is being charged, that margin charges entry will also show on the screen, wherein customers can check how much margins have to be paid. Does the price, does the margins change on daily basis? Yes, the margin will change on daily basis. In case the stock price bought at 100 rupees, it goes to 95.85, and the stock price moves from 85 to 90. If I, as a HDFC, I have a right to debit client's bank account if in case there's a loss. In similar fashion, I will have to credit your trading account in case there's a profit. But as per SEBI guidelines, neither the profit is being added to your limits nor it is credited to your bank account in case the price of the stock goes above the buying price. In case the price of stock goes above the buying price, then the profits will not be credited. So now let us see our research report. Let us see how to place an orders. So I'll just go to our research section. So here you can see our research. So these are the research which we have given, and we have given received returns as well. So if you can check, these are the stocks which have received the West Coast paper. We gave on 28th of September. We have achieved 26% target in 20 days. Singer Electric, 21% target in 4 days. Bank of India, 19% profit in 9 days. So here you can see the details of the stocks which we have shown. Target achieved. So 26%, 21%, 19%, 18%, 17%. So these are list of stocks wherein the positions were research team had given the calls. So our research success ratio is 63%, as I said. Right? Now I'll go to website. I'll check where is it located. HDFC. First, we'll check how to check where will I get the details of scripts which are available in Emargin. I'll simply go down. I'll click on important information. I'll click on the list of eligible scripts. Here I can see the list of eligible scripts which are available in Emargin. So click here to get the list. So I'll get the list of Emargin, how much stocks are available at what haircuts or upfront margin customer needs to pay. So these are the list of stocks which are available for Emargin. Now, when we talk about Emargin, we also talk about how to place an orders. So I'll simply click here, login. I'll enter my username. I'll enter my password. I'll check my OTP. This is an empowered website, the main dashboard wherein customers can place orders. Not only in MTF, customers can place orders in derivatives, mutual funds, IPO, buyback. All the different asset class products are available. From here, customers can place an orders. So if I want to buy a stock, so I'll simply go and buy. I want to buy a stock called in Emargin. I'll simply select on Emargin. Yes. How much margins are available? I'll select here quantity 1 at a price of 3000, for example. Know your margin. So I'll come to know, okay, fine, 900 rupees margin, 30% margin is being charged, brokerage is 5 rupees, the total funds required is 469 rupees. So here, customers' whole account will be debited for 469 and order will be placed to the exchange. Since the market is open, I'll not be able to show the system how to place on orders, but it's absolutely simple, damn simple how a customers can place the order from Emargin. Please note, Emargin is a product wherein you can amplify profit by leveraging more. On leverage, we charge 0.05 per day, that is 1.5 per annum. I'm open for question answer session. I request investors to ask their questions, ask their doubts, if any, wherein I can clear all your doubts and queries. I request investors to ask their questions so I can clear their doubts. Do note, our research is around 63%, and we have given good calls. So I can show you calls as well. I'll simply click here, and these are the calls which we can see here. So we have given good calls as 26%, 21%, 18%, 15%, 14%. All these calls are available. I'm open for question answer session. I request investors to ask their questions and clear their doubts if there's any. I thank each one of you for attending this webinar. Be connected with us for more webinars with regards to Pro Terminal, with regards to SLBM, derivatives, small case DYSIP, where investors can park their funds in different asset class and make money out of it. But please note, there's a very important word called diversification. Investors need to diversify shares in different stocks, different asset class, and different asset class as well. So stocks, asset class is very important. Diversification is the most important factor while growing your wealth creation. I thank you, each one of you, for attending this webinar. Have a great day ahead.